IRS uses an algorithm now to be able to figure out their red flags, right? So they obviously have a ton of data from all different types of businesses, and they put you in a different code. When I do a tax return, I have to put in a specific code of what type of business you are. And it's pretty generic, to be honest. There's not a lot of codes. It's not like, there's 1,000 codes for different businesses. There's like, I don't know, maybe 100. I don't know exactly how many there are, but there's not a ton. Like, for example, a contractor, it's pretty much just contractor. There might be a couple of separations, but there's not, concrete and landscaping and plumbing and electrical and HVAC and gutters and all those other things that there are that you can be a contractor for. So as they collect that data, they understand that if you're making $100,000 in the bell curve, there are some that spend a lot of money in ads and some that spend very little money in ads. And there's some that they should know, or they can kind of see and get an average of how many miles that you are driving or what your vehicle expenses should be based on this age of a vehicle. So they collect all of that data. And if you're outside the norm, too far outside of the norm, then they're going to challenge that and they are going to audit that. Now, they may do a full audit if they feel like there's too many red flags, or maybe they just do they'll send you a letter and they'll say, hey, your mileage sounds off for the amount of income that you made. Send us your proof of your mileage. And then at that point, you need to show your mileage records. So taking big deductions and not being able to show any kind of proof for it can get you in a lot of trouble. If you get audited, you can't prove it. That's one big issue. The next one is drastic income changes with no explanation. If you made $1 million last year and then this year all of a sudden you made $100,000, or vice versa, you went from $100,000 to $1 million of income, that is automatically going to be a red flag and may generate an audit depending on other things. And then rounding everything to the nearest 100, nearest 1,000. If I always round numbers, if it's $5,000.28, I'm going to put $5,000. But if everything is $5,000, I did $10,000 in marketing. I had $5,000 in professional expenses. I had $3,000 in meals, right? You get the idea. If everything is a nice, simple, round number, that is a definite red flag. You always need to have it be. Now, again, if it's legitimately $3,000, like that's how much you spent on, getting your transmission changed in your vehicle, then fine, it's legitimately $3,000. But more often than not, there's going to be some random extra numbers, right? It's going to be $5,012, or it's going to be $3,217, something like that. So you don't want to have the round numbers. And then messy bookkeeping. And again, as I mentioned before, the red flags, the algorithm, they're going to know that you have messy bookkeeping if you have these random categories, rounded amounts, right? They're going to see that, and their algorithm is going to tell them, hey, this is outside the norm, and you're going to get audited. And then the other part with bookkeeping and messy bookkeeping and when doing a tax return is bunching up your numbers. So if you have a lot of different items and you just put it all in, let's say, office expenses, rather than breaking it down. So now you have this huge office expense category, rather than just leaving it office expenses. Let's break that down into maybe 5 or 6 different categories, depending on what it is: printer expenses, subscriptions, QuickBooks, continuing education, office supplies, general office supplies, something like that, where we're breaking it into separate categories, and we can put all of that into the other category. When we do that, it lessens the likelihood of being outside of the norm of that bell curve. And so then we have a less chance of being audited. And then mixing personal and business accounts. I feel like this should be a no-brainer, but we never want to commingle our funds. We don't want to be going back and forth between business and personal and buying Dutch Bros or Starbucks, whatever it is, every single day for $3.50, or I don't know what that is anymore, $6.50. Like, if it's always the same amount and it's clearly for one coffee, obviously that's you on your way to the office or to the job site buying Dutch Bros. That's not marketing. That's not networking. That's just you buying a coffee on the way there. Or you go to the gas station and maybe there's a $70 charge that's clearly gas, but there's also a $7 charge, and that's your breakfast burrito and a Celsius or something like that, right? So as you do those charges, clearly some of those are personal and some of those are business. We want to keep them separate. And then the other thing to talk about that are red flags there is, let's talk about the difference between an S Corp and a Schedule C. So if you are a sole proprietor or a single member LLC, your business expenses and income gets reported on the Schedule C of the personal tax return, the 1040. That has a higher likelihood of being audited. Never mind the savings, right? We won't even talk about the tax savings here in this episode about the Schedule C versus being an S Corp or anything like that. Just the likelihood of being audited increases if you keep it on the 1040 versus going in S Corp or partnership or some type of an entity return. Statistically, that has been what's been proven. It's about 2/3 more likely to be audited on a Schedule C personal return than if you're on an entity return. Why that is simply because there's more auditors available for those Schedule C returns than there are for the other entity returns. Also, they figure if you are now an S Corp, you're some type of an entity, you're more professional, you have accounting records, you have an accountant, you have a bookkeeper, so the records are more likely to be kept correctly versus a Schedule C. Maybe you're a hobby business, maybe you're just trying to put in a bunch of expenses to be able to get write-offs. So they flag you less and they have less availability of auditors on an entity return than on a 1040 Schedule C return.